Okay, good afternoon, everyone. Let's make a start. In case if you have any classes tomorrow, just a reminder that the university will be closed as a public holiday, right? So if you have any classes scheduled for tomorrow, that would have been rescheduled, or some other alternative would have been provided to you. We're now in week 7, and we're continuing with looking at specific accounts within the asset element, and today we'll be focusing on, and the following week as well, we'll be focusing on inventory. So we've looked at cash, we spent a whole week on cash, we looked at accounts receivable last week, and we introduced GST last week as well, and we're looking at inventory this week. Before we get to that, let's have a look at the case study from last week. So the case study is about a distributor of mobile phones in Australia that sold some phones to Dick Smith, which then went bankrupt, and obviously they had to deal with that in their financial statements. Before we get to that specific part of the question, there's a more general question here. And really pay attention to these type of questions, because in the final exam you can get a conceptual or theoretical question. It's not just about the calculations, right? So a question might ask you, well, explain the differences between these two, or what are some of the principles of accounting that we've talked about, some of the assumptions, etc. So it does not have to be a purely calculation-based question, right? So there are two methods of recognizing bad debt expense, right? There's the direct write-off method, which we talked about last week, and we also talked about the allowance method. So explain why the direct write-off method is not preferred by accounting standards and in Australia, specifically, and isn't consistent with the underlying principles in the conceptual framework. So just imagine that you get a question like this in the final exam. We talked about the two methods, the direct write-off method and the allowance method, and the question is asking you, why do we prefer to use the allowance method? So that's the question. And let's say the question is worth 5 marks, right? Now, in the final exam, you might think, well, it's not worth it, I'm not going to attempt it, I'll focus on calculations, but trust me, every single mark counts in the final exam, as well as assignments, right? You might say, oh, this assignment is not worth it, I'm not going to. But in the end, for a lot of students, these little marks here and there, they do make a difference. So the bottom line is that you should be attempting all the questions in the final exam, right? My strategy always is in the final exam, I start off, you don't have to start off with question number 1. I always used to start off with the questions that I felt most comfortable with. And once I do those questions, it would build up my confidence. And if I do rough calculations, I would have an idea where I am in terms of passing or not passing. And then once your confidence is built up, then it makes it even easier for you to continue with the question. So you don't have to start with question number 1 in the final exam. You can start with any question you want. Anyway. So what are the differences between the two, and why we prefer the allowance method over the direct write-off method? Any thoughts? I know that you know the answer to the question. I'm pretty sure that students would know the answer to this question. And it's okay if you can't formulate it exactly how you want it, but we can start somewhere at least. Why do we prefer the allowance method? Well, before we even get to the recovery, we need to talk about writing them off, right? So the thing here, the main thing in the allowance method is that it's the timing difference, right? Of course, if the bad debt is written off in the same period when you made the credit sale, that's fine. You can write it off in that period. The problem, of course, is that it does not happen in this, or does not have to happen in the same period, right? You sold your inventory on credit in the previous financial period. But a couple of months later, in the new financial reporting period, you realize that part of that credit or part of those accounts receivable are not going to be recovered. Right? So then the question is, well, what's the big deal? Why do we have to? So ultimately, the question is, why can't we just record it when we know for a fact that we have bad debts? Why do we have to create an allowance now, which is not as accurate as the actual write-off, but why do we do it now versus waiting until the next financial period? Yeah, so we're getting there. So what that means is that we made the sale in the first, well, in the current period, for example, right? But what we're saying is the period is quite long, or it might so happen that we know for a fact that we can't recover in the following period, but we have to record it now to be consistent with the matching principle, right? And the matching principle suggests that we have to record our expenses that we have incurred in the period in which they incurred to generate our revenue. So we have to match revenues and expenses. So the revenue that we have is our sales revenue. It doesn't matter how we earn it, cash or through credit sales, that's our revenue. What is the corresponding expense for that revenue? Of course, we have cost of goods sold when we make that sale, that's fine. But what happens when part of it is not recoverable? That's an expense. So if it does happen, it doesn't happen with cash sales, right? Because we sell it directly for cash. But with credit sales, it does happen. So if that's happening and there is expense that is attached to these sales, these credit sales, then that expense must be recorded in the period in which we generate these sales. Otherwise, and I was giving you an example last week, when companies delay expenses until the following period, and by doing so, they really distort the financial statements, right? So it's important that even though it is an estimate, even though it is not as accurate as waiting until later on and recording the bad debt expense, it's still better than waiting. Because when you wait and you record that expense, you record it in the period in which it does not belong. And in other words, if we go back and look at the fundamental qualitative characteristics of accounting information, that information is not relevant. If you record it in the following period where it does not belong, it's not relevant. So if managers are given that discretion, if they're given that freedom to manipulate financial statements in that way, if they really want to, they can say, well, we have a bunch of expenses in this period, but let's wait and record them in the following period. And then in the following period, we'll see what we can do. And they do it, and all of a sudden the financial performance is really good. But they just push those expenses into the following period. And then in the following period, say, well, let's try to push them yet in another period, right? So that's not the useful accounting that we have been talking about. The useful accounting would be relevant. Now, you might argue that, well, that's not reliable because it's an estimate, right? And I would agree that it's not as reliable as when we know exactly how much we need to write off. But the fact that we want it to be relevant actually outweighs the fact that there could be some inconsistencies in measurement or the difference between what we measure to be the actual write-off what we estimate to be the write-off versus what the actual write-off is going to be. Right, so accounts receivable write-off or written off whenever the evidence indicates that an account will not be paid. And the keyword here is whenever, right? If it happens in the same period, that's fine. We write it off in the same period. It belongs to this period for the credit sales that we made, and that's fine. But what if that happens in the following period? If it happens in the following period and you hadn't recorded it before, that means basically that you didn't have any bad debts in the previous period when you made the credit sales. But in fact you did, because you had to write it off in the following period. So it's inconsistent with the accounting principles of, well, the probability test. The probability of debtors discharging their outstanding accounts vary with the length of the time. And we looked at the two approaches, at looking at the probability of, or the amount, the proportion of accounts receivable that are likely to go bad. We looked at the income statement method and the balance sheet method. And so by doing that, whenever the evidence indicates, which could be in the following period, we're really not accounting for the fact that there is a probability in the current period that they would actually go bad and have to be written off. So the direct write-off method ignores this probability. It overstates accounts receivable because you wait until the next accounting period. You don't write off your accounts receivable, right? You don't write off your asset. Under the direct write-off method, if you remember, we just basically reduce our accounts receivable. We debit the expense for the amount that we know we're not going to recover, and we credit our accounts receivable. Right? So if we don't do it in the current period, if we leave it until the following period, or whenever the evidence indicates, then what we end up with is accounts receivable that are overstated, because we haven't reduced them, right? And I'm not talking about accounts receivable. I'm talking about specifically net realizable value, right? Because under the allowance method, that's how we reduce our accounts receivable. So, and then of course we have this issue of periodic matching and the accrual accounting assumptions. So if we don't have any balance day adjustment, so we delay the expense recognition, the expense is not matched with the revenue that has been earned, and therefore the periodic profit is less useful. So imagine if you don't have just one expense. Imagine if you have a bunch of expenses like this that you delay until the next period or bring forward from the following period. You recognize it now. I'll give you an example. When a CEO joins a company, brand new CEO joins a company, that CEO has a very strong incentive of expensing everything that he or she can think of, right? And the reason for that is the following. So if a new CEO joins the company and the CEO expenses everything possible, there are two positives in this. First one is that the CEO can say, well, that's because of the old CEO, right? We have to write off all these expenses. Kind of justifies hiring a new CEO. The other thing is, if you expense everything now, next period you don't have that many expenses. And all of a sudden, in the following accounting period, the profitability is much better, right? So these incentives are very strong. We talked about, I briefly mentioned, we don't have a slide on it, but I briefly mentioned about the fraud triangle. Incentives, control, and then the justification for the behavior. So if that happens, if you shift expenses and revenues from one period to the next, then your profit figures are not really useful, because you really don't know whether this profit, most of that profit, has been actually earned in this period, or if it's part of it is coming from the following period, or part of it is coming from the previous period, right? We really want, in order for accounting to be useful, it needs to be relevant and it needs to be reliable. Okay, reliability is somewhat an issue when you make an estimate, but it's still much better than not recording it in the right accounting period. Okay, so it leads to profit volatility, well, to some degree, when it is written off. right? I mean, the profit volatility and the profit going up or down over periods, it's a debatable issue in the sense that investors may not want a lot of profit volatility. They may want smooth profits, right? They don't like uncertainty when it goes up and down. The market reacts to it, and that introduces volatility. They would rather prefer stable increase in earnings or stable increase in profits over a period of time. But on the other hand, then they can provide them with more useful information. So the next question is, and of course, under the allowance method, that would have been mitigated, right? We recognize the probability in the current period by creating the bet and doubtful debt expense and creating the allowance, a negative asset, and we match it. So basically, the revenue that we have earned in the current period is going to be matched with the expense associated with it, which is the bet and doubtful debt expense. Of course, if we knew for a fact that all our credit sales, we would collect 100% of them, that would have been a different story. But you can never tell that with certainty, right? Because you can't predict the future. So how would the write-off of Dick Smith debt affect Roadhound's net receivables under the allowance method? And so we really need to dig into the question. So does anybody remember, or you have the question in front of you, what was the write-off amount? So what happened here is Roadhound is the distributor. I think in the case study it said that they mainly deal with Samsung phones, and that they obviously received Samsung phones from the manufacturer, and they distributed them across different retailers, including Dick Smith. And then Dick Smith, we all know what happened with them, especially I think it all started in 2016. And then we know what happened, and so they basically went bankrupt or went into receivership or administration. They couldn't pay them back. What's the amount? What's the amount that was outstanding from Dick Smith that they were not able to pay back for the company that we're looking at here, Roadhound? What was the amount? $17.7 million, right? So assuming, and they have to use the allowance because they prepare financial statements based on AASB, Australian Accounting Standards Board, and Australian standards, they have to have the allowance. So when they write off, well, they know for a fact, let's say the administrator of Dick Smith called up management of the company, and they said that Dick Smith is not going to be able to pay you back $17.7 million, right? Because they went into administration or receivership, bankruptcy, basically, right? Would that affect the net receivables of the company? And if it would, how much would it affect the net receivables of the company by? In order to answer that question, you need to roughly have an idea of how you would record the write-off under the allowance method, first of all, and then have an idea of, after that, how you would calculate your receivables, your net receivables. So would the net receivables be affected? And if they would be affected, how much would they be affected by? Actually, last week we went through an exercise, and I talked about it. Right? I asked. It wasn't on the slides, but I asked that question, and we went through it. And if you listened carefully to that lecture, or you were in the lecture and you understood what you were talking about, you should be able to answer that question, no problem. Would that reduce our net receivables? Yes or no? Yes or no? Will that reduce our receivables? And if it's a yes, then how much is it going to reduce our net receivables by? What's net receivables? How do we calculate our net receivables? Net accounts receivable. Accounts receivable minus the allowance for bad and doubtful debt. If you do the write-off of $7.7 million, would that difference between your accounts receivable and the allowance change? No? It will not change. Does anyone else think that it will not change? Or does anyone think that it will change? Well, at least we'll have a start. Somebody's thinking that it will not change. No other volunteers? Okay. So, Roadhound wrote off $17.7 million following the collapse of Dick Smith, its biggest customer. We know that. Under the allowance method, such write-off, however, has no impact on the net receivable. So you're right. It wouldn't change. And I went through the same thing last week when we talked through well, it wasn't the exact same case, but we went through a similar question. I was asking, well, if we do the write-off, does it change our net receivables? Net receivables will not change. Of course, the accounts receivable will change, but then the allowance will change by the same amount, and the net effect will be zero. So let's have a look at how that works. So we know that our net receivables is our accounts receivable less the allowance for bad and doubtful debt expense. We know that. Under the allowance method, when the bad debts are written off, what's the double entry when we write off bad debts under the allowance method? We should know it by now, right? We should know what the double entry for that would be. What's the double entry for it? Debit bad debts and credit allowance. Unfortunately, that's not the case, right? Now, when we write it off, the bad debt expense itself is not affected anymore, right? Because remember, the write-off might happen in the following financial period. That's the whole idea of the allowance. We want to record the expense in the period in which we made the credit sale, right? So whenever we write it off, the expense is no longer affected because the expense had been recorded in the previous period. So whenever we write off an allowance, whenever we write off accounts receivable, that means that the accounts receivable have to go down, right? Because we can no longer expect them to pay us back because we know now that they're not paying us back. So that means that we have to credit our accounts receivable. So what do we debit instead? The allowance. Okay. So we debit the allowance for bad and doubtful debt, and then we credit our accounts receivable to reduce our accounts receivable. We debit the allowance to reduce our allowance for bad and doubtful debt expense, and then at the end of the period, if we know how much the allowance should be, we then bump up the allowance. Right? So even though we've written it off, we'll bump it up again at the end of a period based on our new calculations. So it's always there as a percentage of either our total credit sales or based on our aging balance of debtors that we have calculated. So the impact on gross accounts receivable would be minus 17.7 million, yes, accounts receivable reduced, but then your allowance is also gone down by $17.7 million, right? So the impact on net receivables, therefore, is zero. Right, so negative 17.7 million minus negative 17.7 million should give us a zero. So that's it for the question. Any questions regarding this particular exercise? So whenever you see a question like this, don't think that you have to figure it out in your head, right? You can write it down. You can even come up with some hypothetical numbers and see what happens, right? And when you do that, you can clearly see, going through the double entry and recording this, you will see that, There's no effect on the net receivables. If the question says, what's the effect on accounts receivable? Then you say accounts receivable go down by $17.7 million, right? But the net receivables don't change. Okay. So what we're doing today, let me go back all the way to here. You would have cost direct variable. I've removed it because the slides did not reflect it. Instead we are going to be focusing more on these three concepts today. So we're looking at cost allocation to retail investors. We're not really covering cost allocation to manufacturers. Cost allocation to manufacturers is a very difficult topic and will be covered in a lot more detail in management accounting, but not in financial accounting. So we're only looking at retailers. We'll briefly go over the manufacturers, but the focus is on retailers. Then we'll have a look at, that will be the chunk of our lecture today. We'll look at the perpetual versus periodic inventory systems, right? And then we'll have to figure out or find out how we prepare our journal entries to record purchases, purchase returns, sales of inventory under these two different systems. I can tell you right away that the perpetual system is better. It's more accurate than the periodic system, right? But the periodic system arguably is easier to record or bookkeep, in other words. But ultimately, the result is the same. In terms of profits, it will be the same, right? You will still have the same amount of inventory at the end of the period reported on your balance sheet, but the way you record it or go about recording it is different. And it depends on a couple of things, and we'll have a look at it later in the lecture. So we need to identify what inventory is, what is included in the cost of inventory, understand the different inventory cost flows for retailers compared to manufacturers, just briefly. Understand different methods of accounting for inventory. That's perpetual and periodic. Just briefly talk about them and see what the key differences are. Record the journal entries using the perpetual method and the periodic method, and then we have to calculate the closing entries, which are really critical for the periodic method. And once we do the closing entries, then we can calculate the cost of goods sold for the periodic method. That's why the closing entries are important for it. And then we can prepare our income statements, right? If we know all the revenues, expenses during the period, we can prepare our income statement, and you will see that the results under both systems in terms of profit are going to be exactly the same, but there will be some slight differences between them. So let me skip through that quickly. So the standard, so we have the International Accounting Standards Board, and we have the AASB, Australian Accounting Standards Board. The standards are different, but it's essentially the same standard, right? Because Australia accepted the International Financial Reporting Standards, or Financial Reporting Standards. And the standard is on the inventories, which defines and prescribes the accounting treatment of inventory. So the definition and types of inventories. So inventories are assets, we know that. They are current assets. And they can be categorized into these three groups. So we have finished goods, showroom motor vehicles, clothing, kitchenware, etc. Something that is held for sale in the ordinary course of the business. So in other words, you have it available for sale. You don't have to make any adjustments to it. It's already available for sale. It's a finished product, in other words. And up until this point, this is what we were talking about. So whenever we whenever we purchase inventory and we record it through the double entry system, we assume it's finished goods. Whenever we sell inventory, obviously we assume it's finished goods as well. Of course, you have work in progress, right? So it's a good example is a motor vehicle on an assembly line. So you already have some different parts fitted into it, right? So it's not exactly raw materials, but it isn't exactly a finished product. It's work in progress. And you will see that we do have an account for it, a separate T-ledger account for it, which we call work in progress. And then, of course, we have raw materials. So the idea is that we take these raw materials here, we add other expenses to it, such as direct labor and some overhead costs that can be allocated to the production process. And that creates work in progress. Then work in progress is completed, and that goes into our finished goods. And finished goods is what we sell, essentially. So retail, wholesale, and manufacturing businesses make their profits by selling inventory, hopefully at a price that is higher than what it costs them to make them. So for a wholesaler or retailer, it's going to be, the price of purchase of that inventory from a manufacturer, maybe some other expenses. We'll have a look at them later. For the manufacturer, it's, these three different types of expenses and, different stages of production. So the cost of inventories comprise the cost of purchase. We'll talk about it in a bit more detail in just a minute. And the cost of conversion, right, which is more relevant for the manufacturers. Well, it could be relevant for retailers as well if they add any extra features to the product from the manufacturer. So these are the costs that are directly related to the unit of production, including direct labor plus any production overheads in converting materials into finished goods. In management accounting, in fact, I remember from my undergraduate degree, the first unit in management accounting is called cost information for decision making, right? So under management accounting, cost management and cost control is a very, very important topic, right? Because you can argue that when a business starts, when a company starts, emerges, commences its operations, it goes through cycles, right? You have this startup phase, you have the growth phase, you have the mature phase, and then you have a decline of some sort, right? And that could correlate with the company's strategy. Some companies don't really care about expenses. Of course you have to care about expenses, but they really try to innovate, right? They spend a lot on research and development. They have a lot of these other expenses out there to create an innovative product. And they compete based on innovation. But a lot of companies can't do that, or they are beyond that stage. All they're trying to do is generate profit by cutting costs or managing costs as much as possible. And a good way of managing costs is to know exactly what drives your costs. If you know what drives your costs, you can estimate the costs a lot more, you can link those costs a lot more accurately to the production or to the particular process, and you can control those costs a lot better, right? If you know exactly what drives your costs. So, if you have direct labor, obviously, that's what's going to be driving your costs. If you produce more vehicles, there will be more direct labor. But there could be some overhead costs there as well, right? If you can allocate specifically electricity to this line of production, and if you produce more, electricity expense increases, and some other costs that can be directly linked to it as well. These are the conversion costs that are used to basically, take raw materials and from raw materials to get them to finished goods. But of course, you have your cost of purchases there as well. For manufacturers, that would be raw materials. So that's scope of management accounting. So that will be covered in a later unit. Other costs incurred in bringing the inventory to their present location and condition. So on top of just for the retailer, for example, on top of just the cost of goods sold. So if you have a retailer and the retailer purchases inventory from a manufacturer, the price of that inventory is going to be, or that's going to be your cost of purchase, but you also have potentially some other costs that are associated with bringing that inventory over. And we'll look at freight, for example, expenses. So specific design expenses in producing goods for individual customers, but that does not include admin, storage, and selling costs, right? And the reason it does not include those costs is that it's very difficult to link them to your product, right? How much of those costs exactly is allocated to one item of the product that you resell or manufacture, right? So it's very important that we know what costs exactly drive the production, right? Or we can allocate this cost to the production. But these are too far-fetched. They're not really related. Selling costs, that's very ambiguous. Storage costs, it's for a lot of other units, not necessarily the ones that, and not necessarily for the units that you sell in. It could be, your equipment or something else that you store in. Admin expenses, again, very ambiguous, right? So those will not be included But again, that would be covered in a lot more detail in management accounting. So what's the cost of purchase? So it includes the purchase price, obviously, any import duties that you might have. It includes taxes that are not recoverable from tax authorities, right? We know that GST, for example, or VAT, which is value-added tax, used in a lot of countries. A lot of European Union countries are using VAT. Here in Australia, we're using GST. They will not be included, right? Because they can be recovered. You remember from last week's lecture, we, whenever you buy inventory, let's say you buy inventory for $1,100, including GST, the value of inventory that you actually get in is only $1,000. The $100, the difference, is going to be a GST clearing, which is going to be your asset. So that's not part of it, so it's not included, so you have to take it out. Any transportation costs, and there will be an example of that in the student exercise that we go through today. Freight costs, for example, that will be an example with freight costs. If goods are sold free on board shipping point and paid by the buyer, or not included if the freight costs are paid by the seller. So essentially with inventory, it gets tricky. It can get tricky because, especially when you ship it, right? So if inventory is shipped from one place to the next, and it takes a while for it to get there, the question is, well, at what point do you, as a buyer of that inventory, have the rights for that inventory, right? At which point is the responsibility of holding that inventory, of owing that inventory, transfers over to you. So if you buy an inventory, can you, I guess, legally or officially call it your inventory when it arrives in the dock or when it ships from the place of origin, right? And it could be both ways. It depends on the agreement between the buyer and the supplier. The buyer might say that I want inventory to be legally ours the minute you ship it, so that they can logistically control the whole shipping process, right? It's going to make it easy for them if it's legally under the buyer's name. So, of course, if it's at the shipping point and the buyer pays for it, it will be included in the price. But if the seller pays for it, and the seller would normally only pay for it at the destination, then it would not be included in the cost of the product. Other costs directly attributable to the purchase, right? So cost of purchase would exclude any trade discounts, any cash discounts, and any rebates that we might have. So we went through some exercises before where you have a settlement discount by paying cash, or you have a discount right on the spot when you purchase something and or something is on discount, or you purchase something and you get $400 cash back as a rebate, right? That would not be included in the price of your inventory. So let's have a look at the inventory flows, right? Where do we start? How do we get, so where do we start at the beginning of the period, and how do we get to our closing inventory? So we have the beginning balance, right? The beginning balance could be zero, and that's perfectly fine. But if the business has been operating for some time, it's likely that your opening balance or your beginning balance is going to be something that is more than zero, right? So your opening balance in the current period is exactly the same as your closing balance in the previous period, right? If on 30th of June inventory is $10,000, then 1st of July in Australia, in the next first day of the next financial year, it's still going to be $10,000, right? It's not going to change. So what's going to increase our opening inventory? What is going to increase our opening inventory? Yes? Yeah, so whatever we purchase additionally, right, is going to increase our inventory. And so I guess this is already where, we can see some differences between the two systems, and we'll look at it in more detail. But one way you can think about it, and I guess maybe even a more intuitive way of thinking about it, is whenever you purchase your inventory, you record it as an expense. I mean, you paid money for it. That's your purchases, right? Another way of thinking about it, well, you purchase inventory. That's your asset now, so you record it as inventory. So when you record an inventory,
or you would record it as inventory under the perpetual system, you would record it as purchases being an expense under the periodic system. And we'll have a look at it in more detail. So if you have this much inventory, plus you purchase this much inventory, that's how much inventory you basically have to sell, right? And then you sell some of that inventory, and whatever that is left becomes your ending balance, right? So that's what we've been doing for now. So we have opening inventory, we buy additional inventory, we debit inventory, we don't debit purchases, we debit inventory. Then we sell some stuff, right? We record cost of goods sold, we debit cost of goods sold, we credit our inventory. And then that's our closing balance. So opening inventory plus all the purchases, that would be debits to our inventory account, minus all the credits. We should be able to calculate our inventory at the end of the period. Right? How much inventory we should have at the end of the period. But, I mean, this idea is relevant for the periodic system as well, right? The key idea here is that you had some inventory at the beginning, you made some additional purchases, regardless of how you record them, purchases or inventory, and then you sold something, and you have something at the end of the period. And then your ending balance becomes your opening balance in the following period, right? So let's have a look at how it is recorded for the retailers and how it is recorded for the manufacturers. For the retailers, pretty straightforward. We've done this before, right? We have our inventory, we have our balance, we have our purchases, and we would debit our inventory account and credit our cash at bank or accounts payable if we pay in cash or on credit, respectively. And then whenever we sell it, we credit our inventory account and we debit our cost of goods sold. Because, again, whenever an asset is consumed or used, we have to reduce it, and it becomes an expense, right? An asset becomes an expense. Because once we consume an asset, that part of the asset is no longer going to provide us with future economic benefit. And if it does not provide us with future economic benefit, it's no longer an asset. So what is it then? It's an expense. So under the, or for manufacturers, it's a slightly more complicated process because we have 3 different stages of inventory, right? I mean, I wouldn't even call raw materials as inventory, obviously, but we have raw materials, we have work in progress, and then we have finished goods. So first of all, we populate all our raw materials and direct expenses that we can allocate to the production of that inventory. So we have raw materials, debit, labor, debit, expense, right? Any other overhead expenses that we can directly allocate to the production of that inventory. So, and that's fine. So we create all these expenses, right? But then we kind of push them over into our work in progress, right? So, I mean, think about it. Work in progress is a combination of all these things, right? Raw materials plus labor plus any overheads that you use to create the finished product. And when the finished product is created, you then push it away from work in progress into the finished product. And then from the finished product, it's the exact same story as it is here. You basically create your cost of goods sold, and then that goes into your cost of goods sold. So this part of it is exactly the same, right? Except that with manufacturers, we obviously have to deal with the raw materials, direct labor, and all other overheads there as well. So how do we account for inventory? So we have 2 systems, right? We have, or 2 methods. We have the perpetual inventory control method. It records inventory as an asset inventory, and it records it perpetually. So after every single transaction, be it increase in inventory or reduction in inventory account asset is going to be affected. Right? Under the periodic account method, it records opening inventory as an asset and new purchases as expenses, right? And then at the end, through some accounting magic, we calculate the balances. Okay, we'll have a look at it later. Now,
we'll learn how to determine the ending inventory and cost of goods sold when the unit cost of inventory is not constant. So for now, we assume that it is constant, just to keep it simple. But of course, we know that with inventory, you buy the first batch of your product at one price. Second batch is a different price, and it can get quite complicated, right? So we have to be more realistic, and we have to account for the fact that the cost of inventory does not have to be constant. It can actually vary, right? And you know, if it varies a lot, then it will obviously affect our cost of goods sold in different ways. Or depending on whether it goes up and down, and whether you know, the inventory keeps on increasing in price for us as buyers of that inventory. So this applies to periodic and the perpetual system. I mean. Okay. So let's have a look at the perpetual inventory control method in more detail. It's a continuous record, right? That's the idea. It's a continuous record, meaning that all the transactions that pertain to inventory, increase or decrease in inventory, recorded continuously after every single transaction. So a ledger account that is called inventory records all inflows and outflows of inventory after every single transaction that would affect it. The good thing about it is that at any point, after every single transaction, you know how much inventory you should have on hand. So that's quite useful, right? So the amount of inventory that should be on hand is known at all times. This is compared with the amount actually on hand to recognize any stock or gain. So let's say you had opening inventory, $10,000. You purchased additional $10,000 of inventory during the period, $20,000, and during the period you sold $15,000 worth of inventory. So you know that you should have $5,000 worth of inventory. So you go into your warehouse and you count your inventory. You know the average price for your inventory. You find out how many units you have, and you count that inventory, and it only adds up to $4,800. $200 lost somewhere, right? So the benefit of the perpetual inventory system that you can actually find out whether there is a loss or a gain, right? Usually probably would be a loss in most cases, right? Damaged, stolen, whatever the case is. I mean, damaged and thrown away, didn't record it, and then now you know. So actual inventory on hand is determined by physical count, right? So if it's feasible to do so, you can go in and, you know, they're clearly identifiable units and you can easily count them, then you can do that and you can compare it to that and see. Because the other benefit of that is if you know that you should have $5,000 worth of inventory and you only have $4,800, there's a possibility that it was stolen, so you can investigate further, right? Even though the $200 may not be an important amount, but the fact, remember materiality. We haven't talked about it, but I mentioned that materiality could be looked at you know, quantitatively and qualitatively. $200 may not be a big deal, but the fact that somebody is stealing from you is a big deal, right? So let's have a look at the periodic count. So it's a method of calculating inventory that uses data on beginning inventory, any additional purchases that you have, and then at the end you do a physical stock take of your inventory. And if you do that, you can find out what your cost of goods sold is going to be. So if I go back to, sorry, let me just go back to this cycle that we had here. Right? You have beginning inventory, purchases, sales, and an inventory. So if one element is missing, well, you can calculate it, right? So under perpetual system, none of it is missing. You have beginning inventory, you have your purchases, you know all your sales because you record your data all the time. You know how much you have actually by doing your stock take, and you can find out gain or loss that you have there. Under the periodic system, you don't actually record all your sales. You don't record them at all. You keep on selling during the period, you don't record your sales. Well, of course you record your sales in the sense of sales revenue and cash that has been collected or accounts receivable, but you don't record your sales in terms of debiting your cost of goods sold and crediting your inventory because it's a periodic system. You don't keep track of your inventory. Right? So if that's missing, how do we actually find out how much it is? If this component here is missing, number 4, how do we figure out how much that would be if everything else is available to us? Yes? So we have opening balance plus the purchases minus the ending balance would give us an idea of how much we actually sold, right? The problem, however, is, and perhaps you can see it already now, is that if you do it that way, then your cost of goods sold would include any gain or loss that you might otherwise have. Because under the perpetual system, you know what your ending balance should be. You know, and you compare to the actual balance and stock gain or stock loss, you can record it. But under the periodic system, you don't know what it should be, right? You know, well, you know what it is by doing the stock take, but you don't know what it should be. And you will see exactly that point when we prepare or go through the transactions for the student exercise under the perpetual and the periodic system. That will come through very clearly. So there is no continuous record of inventory transactions. There is no record of inventory that should be on hand as a result, right? And we cannot determine whether there is any inventory shortage or gain because of that. So purchase account is used to record purchases of inventory, and that would be our expense account. If there is a return of inventory, right, we don't reverse it. We don't credit the purchases account, right? You might think that, well, if we purchase something and we debit our purchases being an expense, and then if we return it, we just credit our purchases. We don't do it. Instead, we create purchases, returns, and allowance account, right? You can see the theme in accrual accounting. You don't necessarily reverse some of the accounts. You create separate accounts, and you might say, well, it's not as clean, for example, right? So let's say you depreciate your asset. Why don't we just credit the asset, right? The asset has gone down in value. Let's just credit the asset. But we don't do that. We create a negative asset account. We made sales. We return some of the sales, some of the products that we sold were returned to us. Why don't we just debit our sales and reverse some of our sales? Instead, we create sales returns. Why do we do it this way? Allowance. Why don't we just directly credit our accounts receivable? Why do we create an allowance? And so the answer to all these questions is that it provides more useful information to the decision makers, right? The information is enriched a lot when you provide this additional information. Let's say, I mean, even internal users of that information can benefit from it. Let's say we're purchasing lots of inventory. So I'm a manager of a company. We purchase a lot of inventory from manufacturers, and then we resell that inventory, right? So we purchase a lot of that inventory, and let's say we return some of that inventory because, well, we don't like it, right? Or, well, I guess that's not a valid reason necessarily. You shouldn't have bought it in the first place. But let's say we return part of it because it's damaged, or the description does not fit the inventory, or low-quality parts have been used in inventory against your expectations, or something like this. You return it back. If you just take that inventory and you credit it, or in case of purchases, you just credit those purchases, then you don't really know what happened. So you have purchased at the end of a period, and you go like, well, okay, that's how much inventory we purchased. But if you have allowance, you would actually know how much of that, or returns and allowance, you would know how much of that inventory you returned back. And for you as a manager, that could be very useful because you would look at it and you go, well, we actually returned a lot of inventory back to this particular supplier. Maybe we shouldn't be dealing with them. So providing that information, even though it's additional information, additional lines in the financial statements, it's actually quite useful. So it's a contra purchase account, right? It's not the normal balance for it would be a credit balance, but usually we associate credit balance with revenue, but it's not exactly revenue, right? So it's a contra purchase account, so it has a normal credit balance, but not revenue. So which system is better, or which one should we pick? Now, choice is merely a record-keeping choice, right? Not a reporting choice. You would be still reporting your cost of goods sold. You would still be reporting your inventory in your balance sheet. You would still have the same profit. It's just how you keep your records and how you record these transactions. What's important? There could be slight differences, of course. In case of the periodic system, you can't recognize any gains or losses after the stock take, but presumably those are not going to be material. Nature of inventory, right? If you have items that are easy to identify, that I think the perpetual system is going to be easier to implement. Maybe the nature of the inventory is such that it's just a lot easier to do all the purchases and then calculate how much you have at the end to figure out how much you sold, right? Of course, the computer system technology, optical scanners, for example, they've helped a lot with that. If you have your inventory and you can scan every single item that you sell in a supermarket, for example, right? You know exactly which units you sold. You know exactly how much you sold them for. So why wouldn't you know at any point how many items you have left and what's your profitability is right now, right? How much you're selling it for versus the cost, you can figure that out. So technology has significantly reduced the costs of the perpetual inventory system, or implementing the perpetual inventory system. Well, management objectives, I guess, goes back to the cost versus the benefit. But the cost of the perpetual method has decreased over time with improvements in technology. So let's see how we record our transactions under the perpetual system. And some of these transactions would be or should be fairly familiar to you at this stage. Right? Purchase of inventory. Now, we have to deal with GST now, right? We have to have GST in every single transaction that includes GST in it. So when we purchase inventory, well, it depends on whether we purchase it using cash or we purchase it on credit, we debit inventory. Under the perpetual system, which is what we've been doing up until now, we debit our inventory, we credit our cash at bank or accounts receivable, and 1/11 of the total amount is going to be our GST clearing, which is going to be our asset, right? Because if we're purchasing that for business purposes, we can claim part of that back. And if we can claim 1/11 of that back, that means it provides us with future economic benefit, result of past transaction. We control it. Probability is more than 50%. Can we measure it reliably? Yes, we can measure it reliably. So clearly an asset. So GST clearing, even though it's one account, if we debit it, means it increases our GST asset. So what happens when we return the inventory that we've purchased? So when we return the inventory that we've purchased, we basically reverse the transaction. Right? So we debit our accounts payable. We debit our bank account if we purchase it in cash, and we're returning that. We obviously need to get rid of the inventory now. Inventory is gone, so we have to reduce that inventory, and we have to reduce our GST clearing, because if we return the inventory, we can no longer, for the amount that we returned it for, or that GST amount over there, we can no longer claim that back from the ATO, right? So we have to reduce it by that amount. So we have to reduce our GST clearing asset over here by that amount. In other words, again, if you look at it, it's just the reversal of the previous transaction. It does not have to be the same amount. We might have returned only 50% of the inventory or 10% of the inventory, right? But the idea is that we reverse that transaction in full. So what happens when we sell inventory? Again, we've done that before. If we sell it on cash, we debit cash. If it's on credit, we debit accounts receivable. And then we recognize our sales and we recognize our GST clearing, being a liability or the credit to it. So let's say if we sell, just to throw in an easy to divide by 11 number, $11,000, right? If we sell our products for $11,000, then we receive cash, $11,000. If it's on credit, then it's accounts receivable, $11,000, full amount, right? We either receive full amount including GST, or we will receive full amount including GST, but we have not earned the full amount. We talked about it last week, right? We haven't earned the full amount. We've only earned 10/11th of it. Because what's happening is we're receiving money from our customers, but 1/11th of that has to be paid or passed on to the ATO. We don't get to keep it. We basically just collecting that money on behalf of our customers. And so what that means is that we, by collecting it and having to then pass it on to the ATO, creates a present obligation, creates a liability. So in that case, if we sell inventory worth $11,000 to our customers in cash, including GST, then we receive $11,000, but the sales revenue is only going to be $10,000. GST clearing is going to be $1,000. So out of $11,000 cash we received, $1,000 is not ours. We just collect it, but we have to pass it on to the ATO. And then, of course, we have to record cost of goods sold. That's where the main difference is, right? Or one of the differences is that we, after every single transaction, we have to record our cost of goods sold by debiting the expense and crediting our asset, our inventory. We also have to be very clear on this, that when this does happen, okay, when this happens, there is no GST attached to it. There's no GST attached to it. GST would have been attached to it when we purchased inventory. GST would then be attached to it. But whenever we sell it, never, ever do we have GST here, right? Because it had already been recorded. So under the perpetual inventory system, there was always two journal entries when the sale of goods occur, enabling the gross margin to be determined at point of sale. What does that mean? Well, let's say we sell an inventory, $11,000 including GST, right? What is our sales revenue, again? We sell an $11,000 worth of inventory, including GST. What is our sales revenue? $10,000 is our sales revenue. Now, we know, right, because we keep the perpetual inventory system, we know that value of that inventory that we just sold is $6,000. So what is our gross profit? $4,000. So after every single sale, for that specific sale, we know our gross profit. And gross profit is just your sales revenue minus your cost of goods sold, right? Before any other expenses. And we don't know what other expenses there are there. So we just focus on these two. But we have to record both of them under the perpetual system. Under the periodic system, no. We just wait until the end of the year, see how much inventory we have, do the basic calculation, find out the balance. So what happens with the return of sold inventory? So, well, let's have a look. When the inventory is sold, when the sold inventory is returned, we don't debit our sales revenue, right? Again, going back to that argument, we want to provide as much information as possible, so we create like a negative or contra sales account, which we call sales returns and allowances, and we debit that. And because it's a debit and sales revenue is a credit, they will offset each other and it will reduce our sales revenue because it does reduce our sales revenue, or it should reduce our sales revenue because it's a return. Now, we need to reduce the liability. If they return an inventory back to us, we're no longer obliged, or we no longer have to give the full amount of the money that we collected to the ATO, right? So we reduce that by debiting that GST clearing. And of course, if we get back inventory, our inventory, we have to either reduce the outstanding accounts receivable account, or we have to pay them back in cash. The next thing that we need to do is we need to reverse our transaction, our inventory transaction. So we need to debit our inventory and we need to credit our cost of goods sold. It's a pure reversal of the transaction where we debit our cost of goods sold, credit our inventory because inventory goes out. Now inventory comes back in, we'll do a reversal of it, right? I think we don't create a negative cost of goods sold account. I think that's going to get very complicated if we do that. We just reverse that. Now, what's the reason for a return? Maybe they didn't like it. Maybe they didn't actually order it, or something was sent to them by mistake. A different product was sent to them by mistake. If that's the case and there's nothing wrong with inventory, that's where we'll leave it off. right? We just do a reversal and that's it. But what if inventory is damaged? So we send them inventory, outdated, damaged, whatever the case is. Then when we get it back, probably we have to make some adjustments to that inventory, and we'll talk about it later on. Because inventory, if the value of the inventory recorded in your books is less than what you can sell it for, then you have to make adjustments to it. Okay, so what happens when we do a physical count of inventory? So under this method, we're able to conduct a physical stock take of inventory and compare it to our records. And if we find out that we have more inventory in the warehouse than our records suggest, it's a stock gain. If we find less inventory than our records suggest, then it's a stock loss. Right? And the way we would record it is just, if it's a loss, then we have to reduce our inventory and create a separate expense that we call a stock loss, or in this case, inventory shortage expense. Or if there's more, which is, I guess, probably less likely to happen, we are going to record that as a gain, right? So credit balance, meaning that it's going to increase our owner's equity, and at the same time, we're going to increase our inventory because we do have more inventory than we initially recorded at the end of the period. So what happens with the cost of goods sold on the perpetual system? So as the perpetual method keeps a continuous record of inventory, it also updates the cost of goods sold figures, right? As we saw in the previous case, making a sale, you debit your cost of goods sold, you credit your inventory after every single transaction that involves inventory sale. So the closing figure of the cost of goods sold, therefore, is the closing balance of the cost of goods sold in a general account, and that is the amount that is going to go into our income statement at the end of the period. As it is an expense, it must be closed off to the profit and loss summary, which is what we're going to do anyway for all our revenues and all our expenses. So let's have a look at the closing entries under the perpetual system. So first of all, we have our profit and loss summary being debited because we're closing off all our expenses, right? We're closing our cost of goods sold expenses, we're closing our shortage expense, if there is any, there can be, right? And that's an expense, we have to credit it to close it off. And then sales returns and allowances. Remember, sales returns and allowances have a normal debit balance because they reduce our sales, which have a normal credit balance. So to close off our sales returns and allowances, we need to credit them. So we add this up, we calculate what goes into our profit and loss on the debit side, being all our expenses or negative revenues, essentially. And then we do the opposite for sales, of course. Sales is going to be debited to close it off. And any inventory gain that we might have, opposite to this, needs to be debited because the inventory gain would be a credit. We find out what the total of that is. That's going to go into our profit and loss. Then we find the difference between these two. In most cases, hopefully the company is profitable, so they make more revenue than they incur in expenses. And if that is the case, then we would be debiting our profit and loss because the credit side would be higher than the debit side. So to close it off, we would debit the left-hand side of the profit and loss summary, B minus A, and then whatever that is, our profit is going to go into our retained earnings or retained profits. And that is going to be part of our owner's equity, and then we can prepare our financial statements and specifically the balance sheet. Okay, so now let's move on and have a look at how we go about it when we, or how we go about preparing the income statement. So we've looked at how we record our sales returns, how cost of goods sold is calculated, or the record of that is kept throughout the period, how we deal with the stock take and if there is any gain or any loss there. So now we can look at how we prepare our income statement, and that's a more conventional way, and then that's something that we talked about before and looked at examples of before. We start off with our sales revenue. We then subtract or reduce or deduct our sales return and allowances that we have. That should normally give us our net sales, or depends on whether we have any discounts there as well, revenue discounts. or discount revenues. Then we have our cost of goods sold. That gives us our gross profit, less inventory shortage expense, if there is any. That gives us adjusted gross profit. So with the perpetual inventory system, it's pretty straightforward because we don't have to figure out cost of goods sold. We know it. Look at your T-ledger account. All the debits that you have there, all your expenses, you add them up. Credits, if there are any reversals because you returned some of that inventory, you find out the total balance, and that's it. You plug it straight here. That's how you calculate it. Under the periodic system, it's going to be a little bit more complicated. So that's a pretty big exercise, and I'll give you 10 minutes or so to attempt this, and then we'll go through that exercise, and perhaps sometime through we'll have a break. I'm not sure if we're going to finish all of it in the next 20 minutes or so. I don't think so. But I'll give you some time. If you have questions, just raise your hand. I'm happy to come around and help you out with that question. But essentially, what we need to do is we need to, first of all, prepare these journal entries, right? And based on the questions or the slides that we went through just then, you should be able to do it. Some of these transactions are a little bit more complicated. For example, received payment from customers for amount owing less 5% for the settlement discount. So that needs to be, that needs some time for you to calculate, I'm sure. But most of these transactions should be pretty straightforward, right? Again, if you have questions, just raise your hand. I'm happy to help. I'm here to help. Has anyone calculated the first three or recorded the first three entries? The first three? Purchase of inventory on credit, return, and sale of inventory on credit. I'm not going to go through the solutions yet, but if you've done those entries, I can have a look at them. Yes, I'll come over. Okay, let's have a look at the solutions, at least for the first couple of entries. So we purchased, or maybe you can walk me through it. I'll move on to the next slide. You'll tell me what the entry is because I don't have it in front of me. So what happened on the 1st of June in terms of the entry? What's the entry? What happened? We purchased inventory. How much? How much did we pay for it? 8,800, including GST, right? So 8,800 including GST. Did we buy it on credit or did we pay cash for it? Credit. So whenever there is a GST transaction, I know we talked about GST last week, but I know a lot of students are struggling with GST and GST-related transactions. Whenever there is a GST transaction, I always look at the amount that includes GST, right? The amount that includes GST is $8,800, right? It's not 8,000, it's $8,800. 8,800. That's the amount that includes GST in it. And then I determine which account is going to be affected by the full amount of $8,800. Which account is going to be affected by $8,800? Accounts payable, right? Because when we purchase inventory on credit and that includes GST, we have to pay them back the full amount. We don't pay them 8,000, excluding GST. We pay them the full amount, and then they take 1/11 of that, and then they pass it on to the ATO. Okay. So the account that is going to be affected by the full amount of $8,800 is accounts payable. The next step that I take is to find out how much GST is going to be. Again, in Australia, we're lucky in that we can, to calculate GST, we just have to divide it by 11. You take 8,800, you divide that by 11, what do you get? What's the amount that you get? 800, right? So is that going to be a GST paid, or is that going to be a debit to the GST clearing account or a credit to the GST clearing account? It's a debit, right? We paid for it. Well, we haven't actually paid for it just yet in cash, but we will be paying for it. So that means we only have one thing to take care of now, which is 10/11 of that amount, or $8,000, right? So how much is that going to be? Oh, $8,000. How do we record it? That's the value of our inventory, right? So let's go through it, right? So that's the entry. Now, there's a trick to with GST. So let me ask you this way: How do you calculate this amount? So let's say accounts payable 8,800. How do you calculate your GST? Divide that by 11. Okay, your GST is now $800. How do you calculate 8,000? Sorry?
Multiplying 100 divided by 100. It's like 10 by 11.
Yeah. So you can calculate that by dividing this by 11 multiplied by 10. Is that correct?
Yes.
Is there a quicker way of doing it? Yes. You can do that way. 8,800 minus 800, you'll get 8,000. But there's even a quicker and a better way. Multiply by 10. Okay, in this particular case, it's pretty simple. It's pretty straightforward, right? It's 8,800, 800 must be 8,000. It's not that difficult. But sometimes the numbers can be very difficult to subtract. I mean, of course, you can use your calculator. 8,800 minus 8,000, and you will get the number that you're looking for. But you have to use the calculator. If I take 800, multiply by 10, I don't need to use a calculator. I just add extra zero to my calculation. So that's a shortcut to calculating this, right? So with 800, again, it's simple. But if the number is not as straightforward as 800, just by adding an extra zero is a lot easier than doing any other type of calculations, right? Just remember that. Let's move on to the next one. What's the next entry that we have? Return. So we purchased inventory here. We're returning some of that inventory. How much are we returning? $440, and that includes GST, right? So what's the value? Well, actually, let's keep consistent, and let's follow the same steps that we just did. What is the value, what is the account that is going to be affected by the full value or full amount of $440? Accounts payable, right? Accounts payable are going to be affected by the full amount of $440. Then the next question is, what is GST? How much is the GST? 40. Is it going to be GST debit or GST credit? If accounts payable going to be affected and it's a reversal, you debit your accounts payable by 440. If you already have a debit by the full amount, you can no longer have any debits, right? You must have credits. So the first credit is going to be a GST clearing. You credit it because you simply reverse it. This is the amount that you can claim from the ATO, $800. But now that you've returned some of that inventory, you can't claim $800 anymore. You claim $800 minus the 40 that we've just calculated. So the remainder of it, the $400, is going to be a credit to what account? Sorry? But we're not dealing with purchase returns under the perpetual system. Inventory. Right? Well, we purchased it, well, now we're returning it, right?
Yeah.
So that would be the entry. Right? And again, it's a simple calculation, but if you take 40 and just multiply by 10, you will get your value excluding the GST. Let's move on to the next one, and then after this one, we'll have a break. Okay? So what's the 3rd of June transaction? We're selling inventory on credit, right? How much are we selling? 19,800 we're selling. So that's the amount that includes GST. Again, step number 1. What is the account that is going to be affected by the full amount of $19,800? Accounts receivable, right? It's not a cash transaction, it's accounts receivable, so we have to debit accounts receivable by the full amount. How much is the GST component? 1,800. Is it going to be GST clear in debit or credit? Again, accounts receivable would be a debit by the full amount, so we can no longer have any debits in this particular transaction, right? So that must be a credit. And if you think about it, you're selling it, that's GST that you will be collecting from your customers in the future, and that's the GST that you have to pay to the ATO for. For you, it's a liability, right? And then what's the remainder? So what's the remaining part? How much is the remaining part? 18,000, and what's that going to be? Not inventory, right? Sales revenue, okay? So, again, we've calculated our GST clear in 1,800. Instead of, this is the case where it gets a little bit more complicated, right? Of course, you can look at 19,800 minus 1,800, you will get 18,000. Right? But just take 1,800 multiplied by 10 and you'll get your 18,000. Now that's not the end of the transaction though, right? We know what the cost of goods sold was. What was the cost of goods sold? 6,000 was our cost of goods sold. How do we record it? Yeah, cost of goods sold, right? Does not include any GST, and we just reduce our inventory. Okay, everyone, let's have an 8-minute break. Let's get back by 3:40, and then we'll continue with this exercise, and then we'll switch to the periodic system and have a look at it. Yes, sure. Just put that back. Yeah. Yes. Yeah. That's fine, but that's fine because you reference it. So Magani, April 2014. I mean, really referencing it. It doesn't matter. Look, you put the quote mark, and you put the page number. That's fine. Don't worry about it. You sure when you retrieved it? But do you have that magnet? Yeah, you do have it. So that's fine. Look, Ethan, you sent me an email, right? I remember your name now. Look, it seems to be okay. What is this? What is just this? So it's just a new page, right? Just a new page. Okay, so it belongs to it. Look, it seems to be fine. I mean, I understand. See, it picks it up because it knows. So I mean, Turnitin picks it up because it knows that it's a direct citation. It knows it, right? But as long as you provide the reference here and you provide the page number here, you're fine. Don't worry about it. It's just that it picks up parts of the paper or your essay that it can find similarities with. If it finds similarities and we find out that there's that you quoted somebody but without a reference, you'll get in trouble. But you provide a reference, it's perfectly fine. You even given it because when it's a direct citation, you have to provide page number. You've done it, no problem. Don't worry about it. All good. No problem. You're welcome. Questions? No? So what other units are you guys doing this semester? Finance? How you find it finance? Do you like it? Well, it's interesting. For some people, finance is easier than accounting. For others, they just hate finance. Or you can say it, it's better. You can say that, that's fine. Oh, okay, so... Okay, I would not argue against that. That's I think it's a...
About the theory part,
I know that very well. I mean, I studied with a lot of international students myself. For a long time, I taught at Monash for a long time, and I was teaching postgrad. I mean, here I teach undergrad and postgrad. There, I pretty much only taught postgrad, and it was mostly international students. So I know that very well. So what else are you doing this trimester? Financial markets and law. Law. Is it business law, company law? What's it called? Commercial corporations law. Okay. Well, open book exam, right? But from my experience, open book exam. Well, it's so when I was taking law. I was doing business principles of law, business law, tax law. I've done all those units in my undergraduate degree, and they're all open books. But I had so many notes with me. I didn't even use and by the time you go through all the notes, you can pretty much remember all the main cases. I mean, I don't remember anything now, not a single thing, right? But in preparing for the final exam, you remember all these cases, so you don't actually even need to go through a lot of the material in there. I actually don't. If you go in the final exam and you start going through the pages, that's not a good sign, right? Because by that time, you should have remembered and really understood where to look for information. So, yeah. Sorry? No, I came here as an international student myself. I came here from Russia. Yeah. Yeah. So, but I've lived in Australia for the last 10 years or so. So yeah, but I was a student just like you. I studied for 9 years.
Teach and the
Well, I finished my studies by now, so I'm happy to finish my studies by now. It was long 9 years of studying, so yeah, I don't want to study anymore. Okay, let's continue with the exercise. There's a lot of stuff to go through, right? We have all these transactions, then we have to prepare the income statement and closing entries and then the income statement. So the next one, number 4. What's number 4? Or 4th of June. So customer returned 660 on credit, right? So basically, the transaction that we just had has to be reversed to some extent, right? So we sold them inventory on credit. They're returning $660 worth of that inventory, including GST. We know what the cost of goods sold of that inventory was, so we have to do a reversal of the cost of goods sold in the inventory, right? So 660, which account is going to be affected by the full amount of $660? Account receivable, right? $660. So is it going to be a debit or a credit to accounts receivable? A credit because we reduce our accounts receivable. So that means we have to have debits now. What is going to be our debit? What is our GST? How much is the GST? 60 must be debit to GST clearing, right? Because the customer's returning products to us, so we no longer have that much of a liability or credit GST clearing to pay to the ATO because we haven't sold all of it. Part of it was returned to us, so we have to debit it. And how much is the remainder of it is going to be? And what is that going to be? Sorry? Well, ultimately sales revenue will be reduced. I agree with that, but we create a separate account for it, which we call sales returns. Right? Okay, so sales return allowances, GST clearing, and accounts receivable. What about the $200, which is our cost of goods sold and our inventory? Yeah, we get the inventory back in stock, so we have to debit our inventory and we have to credit our cost of goods sold by $200. Number 5, the cell is pretty big, so it must be a difficult transaction. So what's happening on the 5th of June of the financial year? Okay, so let's go back to here and let's have a look. How much do they owe us now after this transaction? They owe us $19,800, correct? That's how much they owe us now. How much do they owe us now? Yeah, so they owe us $19,800 minus $660. So they owe us $19,140. But that's not how much we're going to be getting from them in cash. We're going to be getting that minus the 5% discount. So how much are we actually getting from them in cash? 18,183. Okay, let's have a look. 18,183, correct. And that's going to be cash. We're receiving that in cash, so we debit cash. Again, let's go through the calculation. They owed us $19,800 at the beginning. They returned us inventory worth $660, so we reduced it by it, and we're giving them a 5% discount, so they don't have to pay us how much was it again? Yeah, $19,160, right? So they only have to pay us now, or they paid us $18,183. Okay, what else is going to be recorded in the transaction? So in terms of accounts receivable, do we debit accounts receivable or do we credit accounts receivable? Credit, how much? How much? This number?
9,707.
How much? How much do they owe us before this transaction? 140. 19,140, right? They're paying in full. Even though we give them a discount, we have to reduce that by the full amount. So that's how much accounts receivable will go down by. We also have to recognize a discount. How much is our discount? 957. Well, discount is going to be this bracket multiplied by 0.05. How much is that going to be? 957. So if it is 957, we know that that includes GST, right? Because when we're giving them the discount, we're not receiving the money from them anymore. Well, that discount difference. And as a result, we have to reduce that GST clearing asset that we had before, right? Or the liability that we had before. So in other words, if I go back to this transaction here, this GST clearing, $1,800, it's a liability. We're going to collect that money. But we first reduce it here, right, by debiting it because there was a return, and now we reduce it even further because of the discount. So let's have a look at the calculation. So the discount allowed is going to be 987, as you correctly pointed out, but of course 10/11 of that is going to be the actual discount, and then 87 is going to be our GST clearing, right? And then we add them all together and we'll get the balance that we have to offset it by, $19,140. Okay. Now, how do we calculate this again? Well, we can get this multiplied by 0.05 and then get 1/11 of it, then multiplied by 10 again. You know, you should be able to figure out now how to extract the GST component out of it and calculate the remainder of it. Okay. So that's the receipt of cash from our customers after the 5% discount, also accounting for GST in the process. Is everybody okay with this? Again, just in your own time at home, please do make sure that you go through this again, maybe a few times, and make sure that you understand exactly the steps that we went through here. 6th of June. What's happening on the 6th of June? Yeah, we paid freight expense, inward freight. How much was that? 132 including GST. So that includes GST. Did we pay it using cash? Well, if it doesn't say anything, that we assume that it was paid in cash. So what account is going to be affected by the full amount of $132? But freight is not. It's going to be included together with the cost of goods sold, but it has to be recorded as a separate expense. We can't put it in the cost of goods sold because it's not exactly the cost price of the inventory. So So what's going to be affected by the full amount of $132? Cash is going to be affected by the full amount of $132. So how much is our GST then? GST clearing. How much is the GST? Okay, 13.2? Yeah? 12. 12? 12 and 120? Oh, we'll figure out in a minute, right? But that GST clearing, is it going to be a debit or is it going to be a credit? We paid for it, it's a debit, and the remainder of it, what's that going to be? $120. What's that going to be? The actual expense, right? Okay, so 120 GST clearing, and we have our cash at bank. Okay? So there shouldn't be any residual, right, when you divide 132 by 11. Is there any residual? No, I don't think so, right? Okay, so what's the next transaction? 7th of June. So we paid accounts payable, we paid our creditors in full. How much are we paying for that? How much are we paying them in cash? See, the question does not specify that there is a discount, but we owe them more than what we're paying them. How much do we owe them right now? 8360. That's minus 440, right? So originally it was 8800 minus 440. Again, if we go back, let's go back to those transactions. So we purchased inventory from them. Accounts payable 8800. We return $440 worth of inventory. Well, not exactly worth of inventory, but that's what we returned to, and that was the value of it. So 88 minus 440, that would be 8360. But how much are we paying them in full settlement of the account? 7,500. So we owe them 8360, but we're paying them only $7,500. So that means the difference is a discount that includes GST in it. Okay? So let's go through that together. So the account or the value of the accounts payable is 8360, right? We figure that out. We owe them 8800, but 440 is the discount that we, not the discount, the return that we made before. So we only owe them now 8360, but we're not paying them 8360, we're actually paying them $7,500, right? So $7,500, what account is going to be affected by $7,500? Cash, right? We're paying cash for it. Okay, so how much is the discount revenue that we receive that includes GST in it? 860. So 860 is the discount revenue that we receive that includes GST in it. So how much is the GST component? 78. So, and then the remainder of that is going to be the actual discount revenue that we receive. So cash at bank, that's what we receive. Discount received or discount revenue, 782, and this is going to be 78. Now, I know that in this particular case, you can't get the round number, right? So what we normally do, I mean, we don't use decimal places, we just round it to the fullest dollar. I mean, if you look at the financial statements, there are going to be cents in there, just round to the full dollar. And normally the way I would do it, I would start off with this to calculate my GST. So if you take 860, divided by 11, and round whatever you get to the nearest dollar, 78. Now, if you take 70, so this is where it gets trickier, and you can't use the same sort of, the rule that I shared with you earlier. You can't take 78 multiplied by 10, right? 780, you don't quite get there. So the best way of doing it here is to find the difference between 860 and 78, and that's going to be 782, right? Just be careful. Sometimes numbers are not that easy to calculate, but if you can divide it by 11 without any residual, then you can just multiply by 10 later on. Is everybody okay with this transaction? Right? So GST clearing is on the credit side because we're paying them back, but we're receiving a discount, right? So even though we're paying them back, we're receiving a discount, and part of it, cannot be claimed, and so has to be credited, or reducing our GST clearing asset that we had before. What happened on the 8th of June? Okay, so we did a stock take, and how much do we have on hand? $1,600 worth of inventory. How much inventory do we have right now? Can anyone tell me how much? I mean, this is a perpetual system, right? So you should be able to tell looking at inventory debits and inventory credits, you should tell us, or you should be able to tell how much inventory you have on hand. How much inventory do we have on hand? 2,560? You sure? Well, let's have a look. We didn't have any opening inventory to start with, right? It was 0. So inventory up by 8,000. Inventory down by 400. Inventory down by 6,000. So 2,000, so 1,000, is it 1,600 at this stage? So 2,000 minus 400, so 1,600. What else has happened here? Let's have a look. Inventory up by 200 because there was a return. So it's $1,800 right now. And nothing else affected inventory, right? So inventory should be 1,800, but the stock take tells us that it's 1,600. So if we can only have $1,600 worth of inventory and the records say it's 1,800, we need to reduce our inventory. How do we do it? We record an expense. The expense is going to be the difference between how much we have, how much we record, how much we have in our records, minus how much we actually have, right? And the difference is 200, and that's an expense. And because we don't have that inventory, we have to actually reduce our inventory from 1,800 that we have recorded right now to what we actually have, which is $1,600. Okay? And that's the calculation. Opening minus the return that we had, minus the cost of goods sold, minus what was returned to us. That gives us 1,800, but on hand is 1,600, so we'll do the adjustment there. So now we've recorded everything. We've taken care of the shortage of inventory. Now we can start closing our entries, right? We start off with expenses. So we would be crediting all our expenses or negative revenue, and then we will debit our profit and loss, meaning that goes to the debit side, and then we can find out, after the sales revenue, we can find out our profits. So sales returns and allowance. Remember, they have a normal debit balance. We credit them. Cost of goods sold. The cost of goods sold is 6,000 minus the 200 that was returned to us. Right? So that would be $5,800. That was a discount that was allowed, that we calculated previously. That was an expense. We allowed the discount of $870. Freight inwards, that was another expense that we recorded. Again, we credit all those expenses to get rid of them. And then we have another one, the last one, which was inventory shortage. So now if we add them all together, we can find out how much of that goes to the debit side of our profit and loss, and that's going to be $7,590, right? So basically, we're just closing off all our revenue and expenses accounts. Now let's close off our revenue accounts here. We have our sales, right? $18,000. And we have our discount revenue. So discount revenue would be credited normally. We're closing it off, we're debiting it. If we add these two together, we get $18,782. That goes into our profit and loss on the credit side. You can already see, so we have profit and loss on the credit side minus the profit and loss on the debit side. You can see how much profit we're going to make during this period, right? And the total profit is going to be $11,192. By debiting profit and loss summary, we close it off and we transfer that profit of $11,192 to our retained profits coming from previous periods, and that's how it will end up on the retained profits in our financial statements, and specifically our balance sheet. So that's it for the perpetual system, right? Pay attention to this number, 11,192. When we do the same thing through the periodic system, transactions will be slightly different. Some of the calculations and presentations will be different, but we should arrive at the same amount of value of 11,192. So let's have a look at the income statement. What does the income statement look like? Well, we have sales revenue, we have sales returns, right? Then we have a discount that we received, and that would give us a total of net revenue or net sales of 18,182. Less cost of goods sold, 5,800, and that's it. Just one line of the cost of goods sold. That can give us, well, freight inwards, I nearly forgot about that expense, right? Because it can be directly attributed to us getting the inventory to our location for us to then sell it. Right, so it's not incorporated in the cost of goods sold, but it's part of the direct expense, and it's included over there. So now we can get our gross profit, which is the difference between the two. We had our discount, and then we had our shortage. So less shortage will give us adjusted gross profit, and then we also had the discount there as well. And once we include that discount, we'll get to our $11,192 under the perpetual system. So when we do it under the periodic system, this bottom line will be the same, but some of these numbers will be shifted and transformed, and some new things will be included in there. So let's now move on to the periodic method. Is everybody okay with this? Okay, that's good. So let's have a look at the periodic method. We have our beginning inventory, right? Let's go through that cycle. Beginning inventory, physical count from last period, right? How do we determine our balance? We do physical count. Plus purchases, expenses, right? That's the cost of goods available. That's not cost of goods sold. That's all the inventory that we have available for sale. Cost of goods that we have available for sale. So if we know our ending inventory, right, if we take this, beginning inventory plus purchases, cost of goods available, minus the ending inventory by way of doing a physical count, then we can find out how much we sold, right? Which is different to the perpetual system that we just covered. So assumed inventory sold, or in other words, our cost of goods sold. So, in other words, if we know beginning, if we know purchases, if we know ending by way of physical stock take, we can find out how much our cost of goods sold is going to be. The problem with this is that, of course, that we don't keep constant record of our inventory, and we don't know whether we have any stock gain or stock loss, right? Because whatever there is, there might be a stock gain or stock loss, will end up being in the residual, the difference between them. So let's have a look, or let's go through the transactions and see how we record these transactions. When we buy inventory, we debit purchases, which is an expense. The rest of it is the same. GST clearing, bank account, bank account, cash at bank, or accounts payable if it's on cash or credit, respectively. Right? When we return it, similarly, we reverse this transaction, right? When we purchase the inventory, under the perpetual system, we debit inventory. When we return it, we credit inventory. We do the similar thing here, except instead of purchases, we just create a separate account, purchases, returns, and allowances, right? But the rest of it is the same. We reverse bank or accounts payable and the GST clear in there as well. So what happens when we sell our inventory? Well, this transaction is exactly the same. We debit our bank account, or we debit our accounts receivable. We credit our sales, we credit our GST clearing. It's exactly the same, right? But the difference now is that there's no cost of goods sold. There's no debit cost of goods sold, credit inventory. We don't record movement of inventory after every single transaction. We just deduct whatever we have at the end, and that will give us the number of inventory that we sold during the period, assumed inventory sold during the period. So what happens when we return sold inventory? So similar to what we had before, sales return allowances, that doesn't change. GST clearing doesn't change. Bank, cash at bank, reversal or credit or accounts receivable credit doesn't change, right? It's still the same. as what we had before. The difference, of course, relates to purchase and inventory. Before it was debit to inventory, now it's debit to purchases. And, you know, when you return it, you don't credit purchases, you credit purchases, returns, and allowances. And, you know, when you sell it, you no longer have cost of goods sold, right? So these are the key differences. So let's see what it says. So unlike the perpetual method, there is no second journal to inventory and cost of goods sold under the periodic method, right? We don't have to do it here. So, as the periodic method does not keep a continuous record of inventory, cost of goods sold is not updated until the very end when you do the stock take. Right? The closing balance in cost of goods sold is determined indirectly and involves 3 steps. So the first step would be to close the inventory, opening balance, and I know we'll go through this together. I know it doesn't quite make sense. When we close inventory, if we think of inventory as our asset, right? Here it says close your inventory account, like you close it to profit and loss. So it doesn't make any sense because that's an asset. We don't close assets to profit and loss. Just bear with me for a minute. We'll get to that. You'll see why we actually do it. But we need to close our inventory. Opening balance. Make sure it's an opening balance. Together with your purchases. So they have to be on the same side when you close them. And when you close them, you credit them. Because to close your inventory, you credit them. To close your purchases, you credit them. Right? Because you credit them, you add them together. So remember, opening inventory plus purchases, they have to be on the same side of the accounting equation for this to work. And then we create inventory that is going to equate to our closing balance, which we determine by way of stock take. Okay? So these are the 3 steps that we have to go through. Of course, then we have to also take care of the purchase returns, if there are any. But we do have that in the question, so we'll go through that together. So what are the closing entries? So let's have a look at the closing entries. Credit inventory at the start. That's our opening balance. Credit purchases. By crediting them together, we basically combine them together. So you can see already, if we credit our inventory, credit our purchases, and then we debit our inventory, that is going to give us the difference, which is going to be exactly our cost of goods sold. Minus, of course, any purchase returns that we might have. Okay? But the rest of it is the same. Sales returns, allowances, all of this is closed off to our profit and loss summary. You can see here we no longer have cost of goods sold anymore. We determine cost of goods sold indirectly. And then here we have the same items. Sales, purchase returns, because purchase returns are negative purchases, so they have a normal credit balance, so now they're debited to close them off. And then we have our inventory at the end. So see, by debiting inventory at the end, we actually create inventory. So here we closed it off. Right now, after this entry, we have no inventory at the end of the period. But by debiting inventory at the end of the period after the stock take, we actually create balance to take it forward. So we don't really close it at the end of a period to 0. We reinstate it to the amount that we determine based on the stock take. Okay, and then of course the same thing. It's taken off to our retained earnings or retained profits from the profit and loss summary. So what does it look like in the income statement? This is where it's going to be different, really different from the perpetual system. Okay, sales, you have sales, returns, and your allowances, and then you have your cost of goods sold. So how do you determine your cost of goods sold? Well, your opening inventory, right, plus your purchases that you had, less purchase returns, if you had any purchase returns, less your closing inventory. And that amount right there is going to be your cost of goods sold. That's an indirect way of calculating your cost of goods sold. Of course, if you have any freight or any other expenses that would be included on the cost of the goods sold, that would be included there as well. And that will give you your gross profit. So under the perpetual system, cost of goods sold was just one line, right? Because we know it, we know what it is by looking at all the transaction and calculating all the debits and credits to the cost of goods sold, it's only one line. It was $5,800. Here, we have to go through this whole process to get to this number, but the upside of it is that we don't have to debit cost of goods sold and credit inventory after every single transaction. Okay? Okay, same thing. Exact same thing. Nothing changed, but now we have to go through these transactions using the periodic system. Now, some of these transactions will be duplicated, right? You sell something on credit or you sell something on cash, debit cash, credit sales, credit GST clearing, right? But some of them are going to be different. So I'll give you maybe another 7 minutes or so. Through some of these transactions you can go fairly quickly, but maybe some will take a little bit more time, especially with purchases and purchase returns. But take your time, go through those transactions. If you need help, let me know, and then we'll go through the exercise together. We don't have anything else. We just need to record these transactions, and then we need to prepare closing entries, and then we need to prepare our income statement, and that would be it for today. So we can really spend some time on it and take it slowly and go through them carefully. Does anyone need any help? No? Big part of these transactions or parts of transactions are going to be the same, right? It's not going to change. It's only going to change when you purchase inventory, return it, and sell it. And of course, the closing entries are going to be different. Okay, let's have a look. Let's have a look at the transactions. The first transaction, purchased $8,800 GC inclusive of inventory on credit. How do we record this transaction? Is it going to be any different from the perpetual system? Purchases, right? We're no longer recorded as inventory, we're recorded as purchases. So purchases, but the rest of it is the same. GST clearing, accounts payable, purchase on credit. What happened on the 2nd of June? Sorry? Same transaction? Would it be the same as before? We're returning some of that inventory, right? We purchased it, we're now returning that inventory. We're returning $440 worth of inventory, including GST. Before, we would just reduce our inventory, right? But now we cannot reduce our inventory anymore. We have to reduce our purchases. But we don't do it by credit and purchasing, we do it by credit and purchase returns and allowances. Okay? So $440, what account is going to be affected by the full amount of $440? Accounts payable. Do we debit accounts payable or credit accounts payable? We debit accounts payable. GST, $40. Because it's a debit full amount, it must be on the credit side now. And the reason for that is that we paid for the GST here, or we paid for it, we'll be receiving it back. But now that we're returning part of it, we'll have to reduce the amount of GST that we're going to be receiving back. So it has to be credited by $40, and purchase returns and allowances is going to be $400. Okay, well, this purchases, returns and allowances, it's just basically a reduction of purchases, right? Except we create a separate account for it. But when we calculate our cost of goods sold, remember a couple of slides back, it's opening inventory plus purchases, less purchase returns and less closing inventory. So we do need to know how much that's going to be at the end of the period. So what happened on the 3rd of June? We sold something on credit, right? Would that entry be different from what we had before? Well, accounts receivable, sales revenue, GST clearing is the same, right? It doesn't change. This part does not change. But before, we had cost of goods sold, right? And we had our inventory. Do we have cost of goods sold and inventory here now as a double entry? Do we have it? We don't have it anymore, right? We don't have it anymore. We don't debit cost of goods sold and credit inventory. We'll leave it until the end, and we'll calculate the cost of goods sold indirectly under the periodic method. So what happened on the 4th of June? We returned. Part of the inventory that we sold was returned back to us. How much of that was returned? $660. Would that entry be any different from what we had before? Well, we don't do a reversal to cost of goods sold and inventory anymore, but the main transaction where we have sales returns, GST clearing, and accounts receivable, right, should be the same. So sales returns and allowances, $600, GST clearing, $60, and the accounts receivable is going to be $660. It does not change. Because remember, the only thing that changes is us purchasing inventory. Now it's debit to purchases. Returning those purchases, credit to purchase returns and allowances, and selling that inventory. We no longer record cost of goods sold, debit, and inventory credit, right? And we don't have anything else here. Previously, we would increase our inventory back, right? We would do a reversal of debit inventory, credit cost of goods sold. We don't do it here because there was no cost of goods sold debit inventory credit in the first place. So what happened on the 5th of June? So the amount was settled, right? Accounts receivable, $19,800 minus $660. It's $19,140. They're paying us back that minus the 5% discount. So the transaction would be the same, right? So we have cash at bank. That's what we're receiving in cash. Discount that we calculated before, GST clearing that we calculated before, and they're settling the account in full, meaning that we going to eliminate accounts receivable completely. Accounts receivable right now, 19,800 minus 660, 19,140, and that's exactly how much we eliminate by. Exact same entry, does not change at all compared to the perpetual system, right? Because again, the perpetual system has to do with how we deal with inventory. And that's after that, that's settlement, basically. So it's going to be the same. So what happened on the 6th of June? We paid freight expense, right? Entry is going to be exactly the same. It wouldn't change in any way because it's not related to inventory. It's just another expense. What happened on the 7th of June? Sorry? We're settling now our account with accounts payable, and we're paying them $7,500. Right? Would that entry be any different from the perpetual system? Would it be different from the perpetual system? It should be the same, right? Accounts payable, cash at bank, discount received, GST clearing, exactly the same. It's not any different. It shouldn't be any different because it does not involve inventory here, or purchases, or purchase returns, or anything like this. Okay, so you'll see that most of the transactions would be exactly the same. Is everybody okay, comfortable with this? Okay, that's good. So let's now move on to our closing entries. Now, you see here, we used to have the shortage expense, right? But we don't know what it is under the periodic system. That shortage that we have, and you will see that later on, is going to be fully consumed by the cost of goods sold, essentially. So now let's close off the account. So we normally first close off our expenses, right? Discount expense that we might have, and the way we do it is by crediting our expenses or negative revenue. You know, discount expense or discount that we allowed, we have. Under the perpetual system, we have our cost of goods sold, but we don't have it here. Instead, here we have our purchases, right? As well as our opening inventory. Remember the template that we went through before we started with this exercise? So we have to keep that template in mind. So, well, we also have sales returns and allowances. Because sales returns and allowances would have a normal debit balance, right? And that is not any different from the perpetual inventory system that we had before. But of course now we have purchases, which is different. We didn't have purchases there. We also now have, remember we need to close off our opening inventory. We need to close off our opening inventory account to calculate the difference. So, well, discounts allowed, freights, and inventory at the start. Now, discount allowed, as I mentioned before, it's an expense. Freight is another expense. Then we need to close off our opening inventory. Now, in this case, there was no opening inventory. We started on the 1st of June with 0 opening balances, right? So we had no opening inventory. I mean, there could have been some opening balances, but at least we're not told that there is any opening inventory. So we assume it's 0. So what that means is that to calculate cost of goods sold now is just going to be purchases minus purchase returns minus closing inventory, and that's it. If we add them all together, that's what's going to go into our profit and loss summary under our debit. So now we can move on to our credit for the profit and loss, and that would be debiting our sales revenue, any discount that we had received previously, as well as debiting our inventory at the end of the period. Right? And we know, according to our stock take, it's $1,600 worth of inventory. So we debit our sales, discount that we received, purchase returns and allowances, keep on forgetting purchase returns and allowances, We had that before. It was on the credit side because it was reducing our purchases, right? Here we have our purchases. Here we have our purchase allowance. So here it's a credit, here as well. The normal balance for it would be a debit. The normal balance for this would be a credit. It's reversed now because we're closing off the accounts. And then we have our inventory at the end. So you can see right now, you can calculate your cost of goods sold. Your cost of goods sold is going to be purchases minus purchase allowance, right? Minus your inventory at the end. And it would be $6,000. Does anybody remember our cost of goods sold under the perpetual system? Do you remember how much we had in our income statement under the perpetual system, under the cost of goods sold? 5,800. How much do we have here? How much do we have under the periodic system? How much? Periodic system is opening inventory, which is 0, plus purchases, which is 8,000, minus purchase returns and allowance, minus closing inventory. How much is that going to be? How much is that going to be? How much? 6,000. That's going to be 6,000. 5,800, 6,000. Where's the difference? The difference is 200. Where is the difference? Sorry? The shortage, correct. Before we recorded shortage separately, but now we don't know what it is. It is basically included in the cost of goods sold. Okay. And that's our profit and loss. Now you'll see that profit and loss is exactly the same. These numbers are different, but the bottom line, profit for the period, is going to be exactly the same under both systems, right? Okay. So let's now produce our income statement. Sales revenue the same. We had sales returns, yes, we had sales returns. We had discounts, we had a discount there as well. And that's our net revenue or net sales. Then we need to calculate our cost of goods sold. Before, it was just one line, cost of goods sold, $5,800, right? But not anymore. We have to go through the whole process of calculating the cost of goods sold. So, opening inventory, 0. Plus purchases, 8,000. Minus any purchase returns that we had, 400. Minus our closing inventory. So, hang on. Okay, that was incorporated into this. Sorry. The cost of goods sold total is going to be 6,120, but the cost of goods sold excluding the freight is actually going to be only 6,000, right? Before we had cost of goods sold 5,800, then we had additionally freight included there, which would have given us 5,920, but now it's 6,120, right? Still the difference of $200, right? It's just that it's a bit confusing how we treat it as a cost of goods sold, and yet we have a separate cost of goods sold here, and then we have a total amount here. But it's fine. It's still included under the cost of goods sold. It's just that this amount that we get, which we don't record separately, which is $6,000, is the direct cost, and then we have an additional freight expense here. But if we compare the bottom line here, 6,120, and if I go all the way back to the preparation of the income statement that we had before, right here, right, it's going to be 5,920. It's basically 5,800, 6,000, 120 here plus 120 here and 120 over there. So the difference, whether you include freight inwards or you do not, the difference is $200 basically, and that's the difference because of the shortage that we recorded before. Okay. So let's go through this again. So that's our inventory at the end. So we've calculated our total cost of goods sold, so we can now calculate our gross profit, and we did have we did have a discount there as well. Discount of $870. So the profit for the period is going to be $11,192, which is exactly the same as what we had before. Okay? Do you have any questions? I know we finished a little bit earlier. I think it's just a result of splitting the large topic of inventory into two parts. And so we finished early because across the 2 weeks, there's less to cover, basically. We'll see how next week's goes because it's going to be perhaps a little bit more technical than this. Do you have any questions? I'm happy to stay until the end of the lecture, and if you have any questions related to any of the topics that we've covered so far, I'm happy to take those questions. How are you going with your assignments? With your assignment? When is the assignment due? This Sunday? This Sunday. How are you going with your assignments? It's only 1,300 words, right? Is it 13 or 1,200? 1,200, right? It's only 1,200 words. You do your research, reference a couple of articles, make sure that they're all referenced properly, because plagiarism is a big deal, okay? I sit on committee, well, I don't have to sit on the committee, but I'm part of the committee where we basically look at cases where students plagiarize. It's a big deal, right? Students may end up repeating the unit. They may be excluded from the university if it's if it's a serious offense. Please make sure that you run your report through, turn it in, and if anything is highlighted, you're comfortable that you've included the reference, you've referenced it properly. There has to be an in-text citation, right? We're using the Harvard style. So if you're saying that, let's say there is a famous paper in finance in 50s, right? Modigliani and Miller, 1958. So you say Modigliani and Miller in brackets, 1958, suggested that blah, 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 etc., right? Just make sure that you do include these references in the body, but on top of it, you also have your reference list at the end, right? Don't just, because if you just say something in the body and that's not your idea and you didn't reference in the body and you only included it at the end, you will be in trouble, right? So please make sure you have in-body or in-text citations included in your assignment. Anything else? No questions. Now, before we go, I actually forgot one thing. Or there's one thing that I wanted to do. Let me go back to week 6. I did tell you that at the beginning of this class we will go over the calculation. You might have listened to another recording already, but if you haven't, the question was asking you to calculate how much is owed, right? And that's the calculation at the bottom. So we have to pay the ATO. Well, are we paying? No, it's a refund, sorry. We are going to be getting $2,569 from the ATO. The idea of this exercise was, or this question at the end, was to go through all the debits to the GST clearing, all the credits to the GST clearing, and basically finding out the balance. So if the balance is on the debit side, that means the ATO owes us money. How do we get rid of it? We credit it and debit cash because we expect to get the money from them. Right? And the opposite is true. If we owe them the money, we would debit that account, GST clearing, and we would credit cash because we would pay them. Just make sure that you do get this number. Once you do your calculation, it adds up to $2,569. Okay? Okay, if there are no questions, thank you very much for coming. The class is becoming smaller and smaller, which is quite normal. Really, towards the end of the trimester, I've seen much worse. So it's good we still have the bulk of students attending the class. That's only doing you good, right? That can't be bad in any way. So well done. Now, before you go, please do mark your attendance. And then if you don't have any questions, I'll see you all next week. Thank you.
example there that in the main body we have to include the purpose and necessity of corporate integrated
Yeah, yeah.
and theory supporting this type of goals. How can we
Well, theory meaning that any academic articles that you might find. I showed last week how to access business sources.
that we how can we add in the main
Well,
the main body? We have
surely there are papers out there that tell you what the purpose of IR is and what are the advantages of IR are. So you can just include them in your report and reference to the theory.
So it's better to include the theory in the conclusion part so that
No. Why? The conclusion should never have any ideas that you didn't talk about in the body. Never. Because the purpose of conclusion is to sum up everything that you've talked about. And write your own views. Correct. You shouldn't introduce any new ideas. Never. So all new ideas and your thinking should be in the body. Conclusion is just for the conclusion. To sum it all up very succinctly and then give your own thoughts on it. And that's it. Okay. Sure. Because if you record cost of goods sold, which is an expense, and you record it after every single transaction, you would know how much inventory it sold up until that point. So if you don't record cost of goods sold, how do you know how much inventory you sold? You have to wait until the very end, take the stock take, and find the difference under the periodic. But under perpetual, it's just like, let's say you sell laptops, right? Let's say you have 10 laptops. Let's say you sell laptop number 1, you record how much you sold it at, well, you record how much you sold it for, and you record how much it cost you to get it. And then after 5 laptops, you can say, okay, I sold 5 laptops, the cost price of this was this much, you add them together, you know the value of the laptops that you've sold. If you don't do it, you have to wait until the end of the period, find out how many laptops you have left, and then assume that whatever that is not there is how much you've sold. Under this, you know after every single transaction how much you've sold.
But we use inventories, we just consume the inventory.
Correct.
Yeah, and the cost of goods should be more or less.
More. The cost of goods sold. So the cost of goods sold is going to go up.
Yeah.
So if you make multiple transactions, you again cost of goods sold, cost of goods sold, cost of goods sold. So then you can find out, until ledger account, cost of goods sold, all the debits, you can add them up and you can find out how much inventory you've sold up until that point.
So you mean use cost of goods sales
To find out how
find
much
out
you've
how
sold.
many.
Correct.
to find out how much inventory which means how much inventory sold.
Correct. Because it's a cost of inventory or goods sold. So if you add them up after all the transactions, you'll find out how much you've actually sold. Under the periodic system, we don't record cost of goods, so you don't know.
Yeah.
You don't know how much you sold. So let's say you have 1,000 laptops. If you don't record cost of goods sold after every single sale of every single laptop, you don't know. You wait until the end of the period. It says you go into your shop, you have 50 laptops left. How many did you sell then? 950, right? That's how you find out. But here, you don't have to wait until the end of the period. You know after every single transaction how many laptops you've sold, and therefore how many laptops you should still have left.
But if we write in the transactions, cost of goods sold should be go up.
Yes.
And how about the inventory?
Go down.
Oh.
Inventory is, if you have 1,000 laptops, and let's say today you sell 10, the cost of those laptops goes up because you sold them now, but you no longer have them. So your inventory goes down by 10. So cost up, inventory down after every single transaction.
So they are going the opposite.
They are going in the opposite direction. One is a debit, the other one is going to be a credit. Okay? No problem. No problem.
Thank you.
You're welcome. today is 24. What is it? Well, I mean, it's supported by academic research, right? I mean, academic research develops scientific knowledge, if you can argue that way. So, yeah, you can use it as a reference to build the argument. But then, see, if the paper says, if the academic article says, most companies should adopt integrated reporting, I'm not interested in that. I'm interested in why. Why would they say that most companies should adopt integrated reporting? I mean, come on. If a lot of people say that integrated reporting is good, then it must be adopted. But why? The question is why. What are the advantages of integrated reporting, right? The main question is why. It's not, who should, I mean, these are all technical questions, I understand that, but why? What are the benefits of integrated reporting? That's the key thing. And ultimately, ideally you need to show the benefits. And you also need to show the costs and disadvantages of integrated reporting. And once you do that, so the way you would do it is in the body, you say, well, you start off with the advantages, right? On one hand, there's a lot of evidence that suggests that integrated reporting is good for the following reasons, 1, 2, 3, 4, 5, 6. On the other hand, integrated reporting may introduce some costs or some resistance because of this, and this. And then you conclude, this, in my opinion, I think it's good, or because this, and this. So that's how you can do it.
So what about theories? How can we add the theories?
Theories of references. Just, I mean, what exactly is a theory? I mean, if you read these academic articles, right, they're not written out of thin air. They're not. There are theories in academic articles, right? So you need to make sure that when you read about an article, and it's better to be good, I can tell you right away, it's better to be a good article, because then it's not trustworthy. It's very difficult to publish these articles, but they're much better quality. So if a good quality article says it's very report is good, and then rely on a particular theory, all that theory, and tell us what that theory is, because okay, there's a bunch of researchers, they get there and they say, well, we think integrated reporting is good, full stop. They'll never get published. They need to rely on